Thanks for tuning in to this week's news recap. Voyager Digital filed for bankruptcy. Crypto broker Voyager Digital filed for Chapter 11 bankruptcy. By applying for this type of bankruptcy, Voyager will be able to stay in business while it restructures its obligations and reorganizes its assets and liabilities. The company has $1.3 billion in crypto assets and $350 million in cash held at Metropolitan Commercial Bank, according to the statement released by the firm. Last week, Voyager halted all activities from its platform, including withdrawals. It also issued a notice of default to crypto fund Three Arrows Capital, as the latter failed to repay a loan worth $650 million. Voyager's financials were extremely debilitated by its exposure to 3AC. Stephen Ehrlich, CEO of Voyager Digital, pointed to Three Arrows Capital as the trigger for its bankruptcy. "We strongly believe in the future of the industry, but the prolonged volatility in the crypto markets and the default of Three Arrows Capital require us to take this decisive action," Ehrlich said. If the restructuring plan gets passed by the court, customers with assets in the platform will receive a combination of crypto in their accounts, proceeds from the 3AC recovery, common shares, and Voyager or VYG tokens. Matt Levine from Bloomberg estimated that if the VYG token has no value and 3AC doesn't recover at all, users could expect 72 cents on the dollar. Customers have been hit hard and are blaming Voyager for deceitful marketing. I interviewed Jess Archer, a Voyager customer who has $70,000 locked in the platform. She said, on June 20th, they reached out to a bunch of partners and entered into these NDAs to try to bail him out. And 6 days before that, they sent an email out to us, meaning the customers, reassuring us that they didn't have any exposure to Celsius, they never engaged in DeFi lending. In fact, the Wall Street Journal reports that the Federal Deposit Insurance Corporation is investigating Voyager's claims that the dollars in its customer accounts were protected, up to $250,000, by FDIC insurance. By the way, late Wednesday, TPS Capital, which long dubbed itself the over-the-counter trading arm of Three Arrows, tweeted a statement that it was independent and had separate management. TPS is an independent legal entity and its operations are separate and distinct from those of 3AC, it said. FTX Bails Out BlockFi. FTX, Sam Bankman-Fried's crypto trading platform, has closed a deal to lend struggling crypto lender BlockFi $400 million in revolving credit. The deal includes an option to buy BlockFi at a variable price up to $240 million max. Zach Prince, BlockFi CEO, explained what he believes led to this deal. Crypto market volatility, particularly market events related to Celsius and 3AC, had a negative impact on BlockFi. The Celsius news on June 12th started an uptick in client withdrawals from BlockFi's platform, despite us having no exposure to them, he said. Last Friday, it was rumored that FTX was going to buy BlockFi for just $25 million, a mighty fall from July 2021, when BlockFi was valued at $4.75 billion. So, if it is sold for $240 million, that would mean a $4.5 billion loss from its peak valuation. This is not the first credit line that BlockFi has secured with FTX since the start of this bear market. 2 weeks ago, FTX provided BlockFi a $250 million credit line to help BlockFi navigate the market from a position of strength, according to Bankman-Fried. BlockFi is just one of many crypto lenders that have been struggling in the past few days and weeks. CoinLoan announced on Monday it would be reducing the withdrawal limits due to market conditions. The company said that it had no exposure to the Luna fallout or 3AC. Vald, a Singapore-based crypto platform backed by major VC firms like Coinbase Ventures and Pantera Capital, halted its operations and paused withdrawals amid financial difficulties and volatile market conditions. It is now getting acquired by Nexo, Disclosure, a former sponsor, which will have 60 days to perform its due diligence. Babel Finance is hiring an investment banking firm to help it restructure after it froze withdrawals last month. Rumors spread that KuCoin was insolvent and that it was going to halt withdrawals. However, CEO Johnny Liu dismissed the rumors and warned, "For fudders who intentionally spread unverified info, KuCoin reserves the right to take legal actions." MakerDAO integrates real-world assets. MakerDAO approved a governance proposal to provide a $100 million DAI vault to Huntington Valley Bank, a 151-year-old Pennsylvania-based community bank with $500 million in assets. To start, the bank will receive a loan participation facility with a $100 million DAI debt ceiling, which will grow to $1 billion over 12 months. These funds will help HVB to grow its businesses and support its existing ones. After creating the vault, the bank will post real-world assets as collateral, which include a variety of loans, like commercial real estate, industrial, and government-guaranteed loans. Maker will receive some interesting benefits as well. The first is additional yield. Second is a more diversified portfolio, which reduces risks. Lastly, it will allow real-world assets to enter DeFi. Celsius repaid its entire debt to Maker. Crypto lender Celsius has repaid its entire debt to Maker. Since the beginning of this month, the company has been reducing its debt by millions at a time. In total, it has paid back more than $200 million over 6 transactions, and the last one was done yesterday morning. After repaying the totality of the debt, Celsius withdrew 21,962 BTC, which are worth around $440 million. Last month, Celsius halted withdrawals, swaps, and transfers from its platform due to extreme market conditions. Ever since then, many crypto exchanges have followed the same path. Likely to further improve its financial position, the company has fired 150 employees, according to the block. Celsius released an announcement last Thursday trying to bring calm to its users. We are focused on working as quickly as we can to stabilize liquidity and operations. We continue to take important steps to preserve and protect assets and explore options available to us, it said. However, Thursday afternoon, the anonymous account 0xB1 tweeted that his name was Jason Stone and that his company, Kefi, was suing Celsius. In the lawsuit, he alleges that Celsius manipulated the price of the CEL token, that Celsius failed to hedge against Kefi's trading activities on behalf of Celsius as they had agreed upon, and that the company's financial mismanagement had created an accounting hole of $200 million. He also described what he calls the Celsius Ponzi scheme, in which he alleges that, at one point, the crypto lender offered double-digit interest rates to entice new customers because it could not redeem customers' Ether withdrawals on the platform. As of press time, Celsius had not responded to the allegations. First report issued due to Biden's executive order on digital assets. Thursday afternoon, the U.S. Treasury, in combination with other agencies, released a report on how the Biden administration will regulate cryptocurrencies. The publication resulted from President Biden's executive order on ensuring responsible development of digital assets in March. The fact sheet provides a framework which is guided by the principal policy objectives of the United States. It is supposed to protect consumers, investors, businesses, the U.S. financial system stability, and mitigate illicit finance and national security risks. What's outlined in the framework is intended to ensure that with respect to the development of digital assets, America's core democratic values are respected, said the report. On a related note, on Tuesday, the U.S. Office of Government Ethics issued a legal advisory note with the objective of banning U.S. government employees who own cryptocurrencies from working on crypto-related policies and regulations because of the influence they could have on the value of the assets. On social media, the news was not taken well by the crypto community. People with zero knowledge are going to make laws to govern crypto. It will involve ways to slow the progression of crypto for their friends. And, excellent, make it so regulations are created by those most ignorant of the topic, were some of the comments. A fake job offer was behind the Ronin Hack. The blog revealed the details behind the Ronin Hack, one of the biggest exploits in crypto history, which drained $540 million from the blockchain earlier this year. Ronin is the network that supports Axie Infinity, the biggest play-to-earn game at that time. The U.S. government later tied the attack to Lazarus, a North Korean hacking group. It appears that the hack was facilitated through a fake company's job offer. The blog said that the hack involved a senior Axie Infinity engineer who applied for a job at another firm. He received the offer in the form of a PDF, and when he downloaded it, the hackers were able to introduce spyware into Ronin systems. In this way, they gained control of the system and proceeded to exploit the blockchain. Bitcoin Miners Roundup. With everyone wondering how miners are doing with prices down, there was a lot of news this week regarding crypto mining companies. Hut 8, a Canadian crypto miner, added 5,800 mining rigs to its facilities in Ontario. It said it has no intentions of selling the BTC it mines. Core Scientific, a crypto mining firm, sold over 7,000 BTC, worth $165 million. According to Chief Executive Mark Levitt, it had to cover expenses such as increased data capacity and to pay off debts. Bitcoin miner TeraWulf took a $50 million loan to invest in data center infrastructure. The company wants to take advantage of certain value-creating opportunities that might otherwise not be available during more healthy markets. Riot is moving its operations from New York to Texas to cut third-party hosting fees and lower power costs. In June, the company mined 421 BTC and only sold 300, accounting for a profit of about $6 million. Bitcoin miner CleanSpark produced 339 BTC in June, 9% more than the previous month. However, the firm decided to sell the majority of it. We won't blindly accumulate Bitcoin at the cost of diluting our shareholders and taking on unnecessary debt, CEO Zach Bradford said. Time for fun bits. Bitstamp announced fees, then unannounced them. Last Friday, Bitstamp, a crypto exchange based in Luxembourg, announced that it would begin charging an inactivity fee, which would be paid by users with balances below $200 who have not traded, deposited, or staked on its platform in the last 12 months. The fee was supposed to be €10. However, after receiving very negative feedback, the Bitstamp team canceled its plans. Our goal has always been to be a secure and reliable trading platform that provides industry-leading services, and we do not intend to deviate from this path, Bitstamp said in a statement. Uprise loses millions shorting Luna. Uprise, a crypto startup from Korea, lost 99% of its client funds by shorting Luna, according to Seoul Economic. The company tried to short Luna while it was collapsing, but it got liquidated due to a temporary pump in the price. They lost about $20 million in the process, with only $3 million being part of the company's own treasury. At least the funds lost were not from average retail users. Instead, the report said that the clients were high net worth individuals and corporate entities. Thanks for tuning in. To learn more about Helium, Nova Labs, or Amir, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Anthony Yoon, Matt Pilchard, Juan Aranovich, Pam Majumdar, Shashank, and CLK Transcription. Thanks for listening.